Hello, I'm Diana Jordan. I'm a partner in charge of wealth management for Sikich Financial. I'd like to welcome you today to our presentation on the new 401k fee disclosure rules. Our goal for the presentation today is to assist you with your fiduciary responsibilities as it relates to the oversight of the new fee disclosures and the steps that you should take as the plan sponsor. First, a little background on our firm. Sikich is a multidisciplinary professional services firm with offices located throughout the Midwest. We have over 400 employees and 70 partners that devote their careers to a focused service area. My focus is on retirement plan services within our wealth management practice. We currently provide services to over 200 employee benefit plans firm-wide, including third-party administration, employee benefit audits, fiduciary consulting, fee analysis, investment advisory services, and employee education. Our firm is also the 40th largest CPA firm in the country. We also have a significant technology practice and are in the top 1% of all ERP solution partners in the world. We offer many different service lines, including traditional CPA services like audit and tax. Our firm also provides advisory services, investment banking, technology, and managed services. All built within teams that serve many different industries. Our agenda for the day is as follows. We will cover the goals and objectives of the new fee disclosures. The presentation that we've put together today is going to specifically relate to participant-directed 401k and 403b plans. We'll introduce you to ERISA 408b2 and the new 404a5 required disclosures. We'll talk about how you apply your fiduciary responsibility to the new fee disclosures, how to balance reasonable costs versus your participant interests, and then discuss your powers as a plan sponsor. And then our final thoughts will kind of wrap it all up, but we would encourage everyone, including our clients that we work with, to have a written assessment of the fees that are in your retirement plan. So a few housekeeping before we start into the presentation. We have all the audio lines muted. We do have a lot of material to cover in the next 45 minutes, so please feel free to ask questions as we go via the questions window, and we will respond to all participant questions via email after the presentation today. For those seeking HRCI and CPE credit, our marketing department will follow up with you after the presentation with the information that you need to complete. And for those seeking CPE credit, please look for the 3 key words in the presentation today. All those participating on our call will also receive a survey within an hour after the presentation. And again, if you're seeking CPE credit, you'll be asked to submit those 3 key words. So please write those down as we go along. We would, really enjoy your feedback on the presentation today. For this and for future presentations. So first, a little background on the new fee disclosure rules. The Employee Benefit Security Administration is responsible for administering and overseeing ERISA, which technically stands for the Employee Retirement Income Security Act, which was first enacted in 1974. ERISA is a federal law that sets minimum standards for pension plans in private industry. The Pension Protection Act of 2006 was actually the most sweeping reform of America's pension laws in the last 30 years, and a portion of the PPA in 2006 specifically addressed the need for these new fee disclosure rules because they felt that participants' retirements were being eroded by fees that many considered to be excessive. PPA wanted fees to be a major factor in vendor selection and the choice of plan investments. So they really felt like enacting these new fee disclosure rules would really level the playing field. PPA assigned the responsibility for these new rules to the Department of Labor to write the regulations that would disclose costs in such a way that competitive pressure would ultimately lower the cost to plan participants and obviously make fees more transparent. The new disclosures add the burden of knowledge to this plan sponsor, however, so if you are a plan sponsor on the call today, it is your responsibility to review the disclosures and then to determine if the fees are fair and reasonable for the services that are provided to your plan. There are actually 3 new disclosure regulations that were combined to create an incentive for plan sponsors to act. And those 3 new disclosures are Schedule C. This began actually January 1st of '09, and many of you are probably already familiar with the Schedule C revisions. These were intended to clarify the reporting requirements and improve the information plan officials receive regarding the amounts that are being received by plan service providers for providing service to your 401k or 403b plan. PPA also enacted ERISA 408B2, and this was enacted on July 1st of 2012 for all plan sponsors. And this intends for plan sponsors to ensure that arrangements with their service providers are reasonable and that only reasonable compensation is paid for services. And we'll come back to what reasonable means later in the presentation. And then we're also going to discuss 404A5, and this started August 30th of 2012, or your first quarterly statement on November 14th of 2012. And this disclosure relates specifically to plan participants. And this was designed so that workers are given or have access to the information they need to make informed decisions regarding the investment options that are available within your plan. Now, usually when DOL enacted a new standard, they usually had a period of safe harbor or grandfathering or some sort of amnesty. With the new fee disclosure regulations, there is absolutely no such provision. So plan sponsors must comply and make new arrangements when necessary, regardless of how long your arrangements have been in effect with your current plan vendors. ERISA 408B2 actually provides an exemption from ERISA's prohibited transaction rules if the following 3 requirements are met. The arrangement with the service provider is reasonable, the services are necessary to your retirement plan, and the compensation is reasonable. I think you can see a theme. We have this reasonable, this phrase occurring a lot throughout the new regulations. The new act also introduced a new term, which is a covered service provider, or a CSP. And this defines which firms are required to make disclosures to you as the plan sponsor. So basically, a covered service provider is anyone who reasonably expects to receive $1,000 or more in compensation over the course of the arrangement. The final rule applies to the following covered service providers. Fiduciaries are investment advisors, providers of record-keeping and brokerage services. And what brokerage services means, it's actually your platform provider, or any service provider that receives compensation indirectly, which is a key term here, indirectly from the plan, whether that is providing services for accounting, auditing, actuarial, banking, etc. But the key phrase there is indirectly. The new rule covers all defined contribution and defined benefit plans that are subject to ERISA. So that would be all 401k, 401a, and most 403b plans are covered under ERISA. There are a few exceptions, a SEP IRA, a simple IRA, traditional IRA, or welfare benefit plans. And basically the rule says no contract or arrangement for services between a covered plan and a covered service provider is reasonable unless certain disclosures are provided to the responsible plan fiduciary. Now, the disclosure requirements. Covered service providers must present a written arrangement to the responsible plan fiduciary that contains the following: whether the services are provided as a fiduciary to the plan, a description of each service that is provided, whether record-keeping services are to be provided, and the attributable compensation, even when there is not an explicit charge in your contract for record-keeping, is identified as a part of a service contract. All direct and indirect compensation expected by the service provider, its affiliates, or subcontractors. So a direct fee is fairly obvious. You're charged X% on an annual basis for providing investment advisory services to a plan. Indirect compensation sometimes is a little bit more difficult to detect. And so a form of indirect compensation might be 12B1 fees, sub-TA fees, finder's fees. Sometimes these are paid by the mutual fund companies through the commission to the investment advisor, or in some cases to the third-party administrator if they're a producing TPA. This rule was also meant to include any entertainment expenses that are offset and also any float. So float would be if maybe you made a contribution to your service provider, and maybe the contribution, maybe there was some reason that it wasn't in good order, and maybe it wasn't invested immediately, but was maybe deposited, and the actual vendor might receive the overnight float for that deposit, depending on how their contract is written. A service provider must disclose changes as soon as practicable, but no later than 60 days after the provider has knowledge of the change. And this last point, the DOL did not mandate a specific format for the disclosure. I've reviewed a number of 408B2 disclosures, and I really sure wish that there was a specific format, because we're actually doing a project now for a client, and we're looking through 10 or 15 different disclosures, and every disclosure is different. Some disclosures are 36 pages long, some are 3 pages long, and very specific as to what the fee is. The 36-page disclosure, it takes a while to get through all of that information to determine what exactly the fees are. So I do not know if this is an option going down the road for DOL, if they may address this, but it would be nice if we had a specific format for the disclosure, so that it was a 3 or 4 page document and it was very specific as to what exactly the plan sponsor or the plan was being charged for the services that were provided. Now, your responsibility as a plan sponsor first, and I guess I need to explain too, the reason why we're talking about how you need to implement your fiduciary responsibility now is that these disclosures were actually needed to be provided by July 1st of last year. But what we have found from a number of folks that we talked to is they received their disclosures timely from their vendors, and then they filed them. But actually, you have a lot more responsibility for those disclosures. So first your responsibility is, did you receive it, and was it timely? Next, if you did not, or if the disclosure upon review is incomplete or inaccurate, the plan sponsor, you are actually required to take specific actions and ultimately file a complaint online with the DOL to obtain exemption from liability. And you would only need to take that specific action with the DOL if you, in discussion with your vendor, cannot, review your disclosure. You may not be able to understand it, et cetera. So I don't mean to, form a complaint online, but you really should review it, make sure that it's complete, and we'll talk about how to do that here in a moment. So again, plan sponsors should make a good faith effort to understand the disclosures for completeness, for accuracy, and determine if the disclosures are usable. Then, if you cannot get through these 3 tests, then that is when you would need to go and maybe file a complaint online with the DOL to obtain that exemption from liability. All right, so for completeness, check to make sure that fee disclosures were received from each covered service provider. Check to make sure the disclosure that was received to determine if other covered service providers are mentioned and from whom no disclosure might have been received. For many of you, you have multiple folks that you work with in your 401k plan that you may be paying a fee to. So the focus of this is to make sure that whomever is referenced within those different 408B2 notices, that you make sure that you have a 408B2 notice from each of the vendors that provide you a service to your plan. Check that all categories of information are included in the disclosures, the services that are provided to the plan, if they are a fiduciary, their status, costs, etc. Check that the information is clear and usable for determining if services and costs are reasonable, and if not, if it is not clear as to what you're being charged, request additional information to ensure that you understand the fees that you're being charged in your 401k plan. For accuracy, compare the information provided on the disclosures to your contracts. Make sure that you've read your contract. That's very important. Compare the information for consistency across multiple providers. If a trustee reports that it expects to pay the investment advisor 50 basis points annually, or 0.5% of the assets that you're managing, ensure that the investment advisor's 408B2 disclosure reports that it will receive 50 basis points, or 0.5% on an annual basis. And then it's very important to compare this key information for consistency across the multiple types of disclosures that you have. So you want to make sure that your Schedule C says the same thing that your 408B2 notice says, and that eventually we'll talk about 404A5. We want to make sure all three of those disclosures are actually saying the same thing. For usability, make sure that you can determine the fiduciary status of the service providers. Do you understand and can you interpret the total annual cost of the services provided to your plan and to whom the covered service providers are charging for their services? Is the plan sponsor paying for a portion of the fees? Are the plan participants bearing the majority of the cost for operating the defined contribution plan? If not, do you need additional information from your vendors or your covered service providers? Or do you feel like you have all the information, but you're not sure exactly how to put it all together? Do you need assistance from an expert? Now, the plan sponsor does have some relief. The DOL prescribed procedure relieves the plan sponsor of fiduciary liability in the event that the disclosure requirements are not met. This procedure consists of you need to request needed information in writing to your coverage service providers. And then after 90 days, if you do not receive what you need in order to make those disclosures usable, you should report the failure of your service providers to the DOL. And the last point is renegotiate your contract or replace the service provider if necessary. Now, enforcement for ERISA 408B2. A lot of the responsibility is all back on the plan sponsor. Plan sponsors face the penalties of a fiduciary breach and a prohibited transaction if they fail to monitor the disclosures. In addition to the threat of regulation, noncompliance also exposes the plan sponsor to litigation. And as you may know, there are several class action lawsuits by participants against plan sponsors that are currently pending, and a lot of these focus on fees. So the new fee disclosure regulations really create the opportunity for many more such actions if you do not take your responsibilities as a fiduciary seriously. All right, 404A5. This disclosure is specifically for participants, and it includes disclosure of plan investment-related information and of the expenses that are charged to participant-directed accounts. The purpose of this was to ensure that all participants and beneficiaries have the information they need to make informed decisions about the management of their individual accounts. They are aware of what expenses are being charged to their accounts and why the expenses are charged to the account. In our plans that we manage, that we're actually totally fee transparent. So the folks that we work with have seen our fees all along. We look at our fees, we benchmark our fees. So in some platforms, the fees are sometimes not very easy to determine. So that's really kind of the root of all these new regulations, is they're trying to make fees basically a level playing field and more transparent. Now, you may have heard of ERISA 404C. The new 404A5 actually almost completely replaced ERISA 404C. So what ERISA 404C relates to is it provides that a plan sponsor is relieved of the responsibility and liability for a participant's investment decisions only if the participant has exercised meaningful independent control over the investment of their account. Okay? The new regulations now specify that for this standard to be met, the participant must have the opportunity to obtain sufficient information to make informed investment decisions. Also, the plan sponsor must prudently select and, very important, monitor the service providers and the plan investment alternatives. I talk with a number of plan sponsors, and sometimes plan sponsors believe that because they've selected a specific platform provider, a national platform provider, that it is really the platform provider's responsibility to monitor the investment options. But actually, what ERISA says is that you as the plan sponsor have a responsibility to prudently select and then monitor all of your service providers, and that includes the investment alternatives that are offered within your plan. So ERISA 404A5 disclosures, there's two types of disclosures. The disclosures should include the estimated investment fees and expenses and participant rights that are reported on an annual basis. And then on a quarterly basis, you must provide the actual administrative costs. All right. Implementation dates, basically last August was when these should have been required. And probably for most of you, you're seeing maybe a new supplement in your enrollment book, and probably an additional form within your quarterly statements that include all these new disclosures. All right, the general requirements for the new 404A5, plan-related information must be disclosed to participants on or before the date they can first direct their investments and annually thereafter. It should include general plan information, an explanation of how to give investment instructions under the plan, and a current list of the plan's investment options. Also must include administrative expenses information, the fees and expenses for legal, accounting, and record-keeping services, and then any individual expense information, such as the fee to take out a loan or a hardship withdrawal or a distribution, must be included in its general requirements. The actual costs incurred, participants must receive quarterly statements showing the dollar amount of the plan-related fees and expenses actually charged to or deducted from their individual accounts, along with a description of the services for which the charge or deduction was made. And these disclosures may be included, as I mentioned, with the participant's quarterly statement. Investment-related information must be disclosed to participants on or before the date they can first direct their investments, and then again on an annual basis. I will tell you from the vendors that we work with, we are doing this, most are doing this on a quarterly basis. The disclosure must contain performance data, 1, 5, and 10-year, with a comparison to the benchmark, investment fee and expense information, the internet website address for more information, and then a glossary of terms. The final rule, this I do, and I'm very glad that they actually provided a model comparative chart that could be used, because I think this is a little bit easier than navigating the 408B2 notices. The purpose is to help participants, again, make informed investment decisions. The regulations specifically require that information is understandable by average participants. Plan sponsors should review these disclosures and make any changes necessary to make sure that they are understandable by your participants in your plan. And the way to do that, what we've done in our plans, is just ask folks within your retirement plan, do these, new disclosure rules, do you know what they mean? I think that's, really the best way to make sure that the average participant does understand the reason behind these new fee disclosures. ERISA 404A5 enforcement, a plan administrator will not be liable. There is a safe harbor for plan administrators for the completeness and accuracy of information used to satisfy these disclosure requirements when the plan administrator reasonably and in good faith relied on the information received from or provided by a plan service provider. So it is important that you review this information, that you document that you have reviewed the information. Merely do not just put it, assume that it's correct and, put it in your file. So let's talk just a bit about fiduciary responsibility. I know this term is really thrown around a lot in our industry. So ERISA imposes a fiduciary obligation on the plan sponsor. Fiduciaries are required to observe ERISA's exclusive benefit rule and the prudent man rule. Let's talk about what those two rules mean. Why you as a fiduciary or as a plan sponsor have all these responsibilities to oversee the plan for the benefit of your participants and your beneficiaries in your plan. So first, ERISA's exclusive benefit rule. ERISA Section 404A1A requires that a plan sponsor execute the plan-related duties for the exclusive benefit of participants and for the purposes of defraying the expenses of administering the plan. Plan sponsors, therefore, are obligated to review the fee disclosures to improve the success of the plan and to ensure the fees are fair and reasonable for the services provided. Now, if you have a difficult time of determining what the fees are that are being charged to your plan, there is a great handout on the DOL website. We've given you the link here. And this really provides step-by-step instructions on how to determine the fees in your retirement plan. Sometimes it is, even with instructions, it is difficult. This is something that we do for our clients, and if you do need assistance, we would be glad to help you with that endeavor. But for some, folks have been able to use the DOL fee disclosure and to follow their instructions. So if you do have questions within this document, we would be glad to help you and point you in the right direction. All right, the prudent man role. Under ERISA Section 404A1B, a plan sponsor must discharge his or her duties with the care, prudence, skill, and diligence that would be exercised by a reasonably prudent person, and this is very important, who is familiar with such matters. If plan sponsors do not possess the skill to evaluate the reasonableness of the new fee disclosures, they should select an expert to perform the evaluation and make recommendations. So what ERISA says is that a reasonably prudent person who is familiar with such matters. You can't really rely on, I'm not sure about the industry, I don't know how the fees work, etc. You really do need to seek out expertise to help you evaluate, if you cannot do it on your own, these new fee disclosure rules. So how do you determine what is reasonable for the services provided? And I have about 15 years in the industry, and fees range all over, from a very, very low-cost plan with little service to, a fantastic plan where 100% of your participants are on track to replace their income at retirement. So how do you determine what is reasonable within, all of these different vendor platforms? We utilize Fiduciary Benchmarks, and I've given you the web address for this company. You can go directly to them as a plan sponsor, or we have provided a service for clients and kind of quarterback the whole process to determine basically what you are doing is taking everything you know about your plan and benchmarking it against other plans that are in the same number of assets, the same number of participants, and sometimes the same industry. So they're totally independent. The provider is all online. The reports are fantastic. The benchmark reports are primarily used for fiduciary documentation as a part of a plan review process. So for our plans, we go out every 3 years and we benchmark blindly against all the other plans, within their specific peer group to determine if the fees that we're charging, along with the vendors that we work with, are fair and reasonable for the services that are provided. The benchmark reports, in addition to fees, they also provide information like how many plans have automatic enrollment and progressive savings. How does your match compare to the other plans if you have one? Is there a profit sharing component? What's your education process like, et cetera? So it's a fairly comprehensive report, and it's something that we have used with our plan sponsors, and I think it is very direct and to the point. So I would encourage you to look at Fiduciary Benchmarks, totally unaffiliated with them. We just like their reports and have enjoyed providing that service to our plan sponsors. Here's just a few snapshots of the type of summaries that the Fiduciary Benchmark reports provide. So it gives you an overview of the plan assets, number of participants, the industry, whether they have automatic enrollment and progressive savings. Obviously, we look at fees, and there's a summary by different service providers within the analysis. And then there are comparisons to all the other plans within that specific peer group, usually 25 to 35 other plans, and where your fees fall for each of the folks that provide services to your employee benefit plan. And then plan complexity. I really like this. This talks about plan provisions, your employee contributions, who has Roth, who doesn't, if you accept rollovers, etc. So it's a very nice report. So final thoughts on fee disclosures. It's very important that you know what the costs are in your 401k plan. Usually, the costs of the retirement plan are being borne by the participants. So you should know what the total cost of operating your plan is. Remember, you don't have to select the lowest cost provider. You can have, a higher than average cost for your plan. If you can certainly document that the services that you're being provided are, among, the best options that are available out in the retirement plan industry. You do need to know if there are any indirect payments that are routed from the plan to various service providers, those indirect payments that we talked about. And you should know what services are being provided to your plan. the services that are performed by each of those covered service providers, and particularly if services that were thought to be provided but are not and or are not available. All right. Know the nature of relationships. This is very important. Which service providers are acting in a fiduciary capacity and which are not. That's important. Sometimes if you're being charged, X fee and the advisor that you're working with is not a fiduciary and therefore doesn't have that legal responsibility to the plan, but in many cases you might be able to find someone who wants to act in a fiduciary capacity and will basically provide it for the same cost to help you fulfill your fiduciary responsibilities under ERISA. Know the cost burdens on participants, the differences between what participants believe they are being charged and the actual facts. And that kind of goes back to the root of take those 408B2 and the 404A5 disclosures and make sure you read through them. Make sure there is some documentation to ensure that if there was ever a question from the DOL or through any litigation that you've done your fiduciary responsibility. If you can do it on your own, that's fantastic. If you cannot, we would encourage you to hire a prudent expert if you don't have the expertise in-house to determine whether those fees that you're paying for in the plan are reasonable. And again, document the disclosure review and discuss and memorialize in the minutes of your next retirement plan committee meeting for the plan's permanent file. That's very important. Documentation will help you provide that history of your plan. I thank you all very much for your time today. I know we had about a half an hour to review, and I'm 2 minutes over, so I did pretty good. It was a lot of information to cover. If you do have questions, we are going to go ahead and leave the question window open. So also my email address is there, and if you would like to ask something one-on-one, we would be glad to help you. I really do appreciate your time today. We had quite a few folks on the call, and we know your time is valuable, so we appreciate you spending it with us. We will be sending you a survey, so please take a few minutes and complete that for us. We'd like to know what you thought of the presentation today, and then if there's anything future that you would like us to cover. So thank you all very much, and have a great day.